Okay, this video will show you how to do some inventory journal entries. So here we have transactions above. So on April 5th, they purchased inventory on account for $19,000 with terms of 2% if paid in 10 days, net due in 30, FOB shipping point. So that means the buyer pays the freight. So that we'll record our journal entries. So our first one is going to be on April 4th. And our account that we will debit is going to be inventory. And then the account that we credit is going to be accounts payable because they purchase it on account. So the debit is the 19,000 and the credit. Okay, then on April 6th, we pay the freight. So then when we pay the freight, we also debit inventory. We increase our costs to get that inventory on hand. So that's $800. And then that is going to be, I guess I can't tell, is it paid on account? It doesn't say on account, so we're going to assume cash. Then we've purchased equipment on account from the Holofield Manufacturing Company on April 7th. So we debit equipment for $23,000, and again on account means the credit goes to accounts payable. Okay, then on April 8th, we returned some of the merchandise. So we are going to reduce what we owe. So this goes back, our first transaction was to the Garcia Company. So here's where we set it up. We charged inventory and we set up the accounts payable. Now if we return it, we're going to reduce what we owe them. So to reduce that accounts payable, we debit it for the amount that we return, which is $4,000, right? And then we also need to take it out of our inventory because again, we returned it. Okay, then on April 15th, we paid the amount due to Garcia in full. So if we go back to that, we had terms of we saved 2% if we paid in 10 days. So that was on April 5th. 10 days later, we pay it. So that means we earned this 2% cash discount. So if we come down here on April 15th, we are going to alleviate that entire amount that we owe. So we're getting rid of that entire accounts payable. So again, started at 19,000, but we reduced it by 4,000 when we returned the goods. So that leaves $15,000 left. Okay, then we are going to credit our cash, but our cash is going to be the $15,000 times 0.98. Or you could, that's the complement, think back to business analysis with algebra. If we save 2%, we're paying 98%. So then let me calculator here. So $15,000 times the 0.98 gives us $14,700. So that's actually what we're paying. Now, if you wanted to, you could take the 15,000, multiply that by 0.02 or 2%, and you'd say, okay, that's a $300 discount or purchase discount. So in this case, it just reduces our inventory. So again, that would be by taking the 15,000 and then multiplying that by the 0.02. And then you can see that that's what makes our entry balance. Okay, then B says, now assume that they pay the balance due on May 4th. So then in that case, if we paid If we paid it on May 4th, then we would not earn that discount. So we would reduce our accounts payable by the 15,000, and we would reduce our cash, whoops, not the, take that part away, by 15,000. So if we waited those extra days, we would not save that $300. So then those would be the entries that you would need to make as you're recording those inventory transactions.